Small caps had a very strong reporting season over August, and pleasingly, IML's small and mid cap portfolios were stronger again. I think first and foremost, many of the corporates that actually reported very strong cash generation and very good strong balance sheets as well. So what that allowed was for corporates to really start announcing greater dividends. So we saw growing dividends, we saw higher dividends than we did this time last year. And we also saw companies announce quite a few share buyback plans as well, and that was very well received by the market. I think at the same time, that merger and acquisition thematic, which we've seen playing through in markets in recent months, reared its head again over the course of reporting season. So, for example, Z Energy, one of the larger holdings in our small and mid cap funds, received a bid from Ampol, and that was obviously very beneficial to the performance of the funds. There are a number of very good performers for the IML small and mid cap portfolios over reporting season. Pact Group was a particular highlight, one of our largest holdings in the portfolios, up 10% for the month. The result really an endorsement of management's strategy to refocus on the core rigids plastics manufacturing business. As a result, we saw very good cash spun off the business as a result and very good deleveraging of the balance sheet. What was particularly exciting for investors was management's long-term EBIT targets for that business. Management looking to take margins from 6% currently up to 10%. Australian Clinical Labs was another very good performer for the funds, up 16% for the month. A recent addition to the portfolios, ACL is the third largest pathology company in the country, clearly benefiting from the surge we're seeing in COVID testing volumes. But what was very pleasing about the result was two things. Firstly, the fact that their non-COVID volumes or their business as usual volumes saw very good growth, particularly in the second half, up 14% on the prior corresponding period. And secondly, the result was really an endorsement again of management's investment into the business over the last 3 to 4 years. Their investment in technology, their investment in their laboratory systems, and that really allowed for significant operating leverage through the company as a result. Hipages was another very good performer for the funds across reporting season. Hipages is one of a number of technology stocks which we own across the funds in small and mid caps. It was up 14% for the month, a very good performer, really on the back of its continued dominance of the online marketplace for tradie services. So what we saw during the result in August was management really consolidating their leadership in that online digital marketplace for tradies. We saw very good network services emerging, and what we are seeing is as every additional unit of volume comes onto the platform, they're coming on at very high incremental margins. What we're really excited about is management's longer term plans to really dominate that online tradie space and really make Hipages the one-stop shop for both tradies and consumers to come together and transact online. We really think the bedrock of the portfolio is formed by a very good grouping of what we would call defensive and resilient dividend payers. So the likes of AusNet, the likes of Metcash, the likes of SG Fleet, the likes of Tabcorp, all paying upwards of 3, 4, 5% dividend yields, which we think are very defensive and growing going forward. So we think that's a very good backbone for the portfolios. On top of that, we have a very good grouping of what I would call defensive growth companies. So we have overweights in the portfolio to the healthcare sector, to the consumer staples sector. And we think those types of names, the likes of Integral Diagnostics, the likes of Bega Cheese, for example, have very good growth prospects in front of them over the short to medium term. So we think that, again, they're a very good contribution to the portfolio going forward. And lastly, we think there's very good pockets of value sitting in the portfolio. So if we look at the likes of Z Energy, the likes of Australian Pharmaceutical Industries, they're both very good value opportunities which have been recognised by merger and acquisition acquirers in the market at the moment. And we think there's very similar stories are likely to play out for the likes of TPG Telecom, for example, the likes of A2B, both very good quality companies trading at very good discounts to the market. We think opportunities like that in the portfolio will be unlocked over the next 18 to 24 months.